U.S. markets are currently closed for trading. The last session for Bitfarms, ticker BITF, concluded on Friday, October 24, 2025. The stock finished the day at $4.61, which was a very strong surge of $0.445, or 10.68%. That move happened on significant volume of over 103 million shares, capping a week of truly wild volatility that saw the stock trade as high as $4.77 and as low as $4.47 on Friday alone, and swing in a range of nearly 30% over the past few trading sessions. Now, the immediate surface-level assumption, the expectation, is that Bitfarms just had a great day because Bitcoin had a great day. And with Bitcoin consolidating around the $108,000 level after its recent flash crash and subsequent recovery, that's certainly part of the story. But it is not the real story. The reality is that this 11% pop is the market's confused, excited, and terrified reaction to Bitfarms fundamentally altering its own identity. The company just took on a massive amount of new capital, and it's not just to buy more miners. It's a high-stakes pivot that redefines the entire risk profile of this stock. And it seems like half the market, especially those engaging in Robinhood stock trading, haven't quite grasped what this means yet. Let's establish the common ground, the simple narrative that has driven this stock up over 400% in the last 6 months. The expectation is that Bitfarms is just a levered beta play on Bitcoin. It's a mining stock. Bitcoin goes up 5%, BITF goes up 15%. Bitcoin goes down, BITF collapses. It's the go-to speculative asset for people who want exposure to the crypto space without holding the actual coin, something they can buy right in their Robinhood app or on the SoFi active investing platform, right alongside their Tesla stock or Apple stock. It's treated by many as a proxy for Robinhood crypto exposure. This is the story that's easy to understand, easy to trade, and it has worked spectacularly well for momentum traders. The problem is that story is now dangerously incomplete. The reality is that Bitfarms is in the middle of a profound strategic shift, one that is both brilliant and incredibly risky. They are actively trying to diversify away from being just a Bitcoin miner and are transforming into a high-performance computing, HPC, and artificial intelligence infrastructure provider. This 11% stock surge isn't just about the price of Bitcoin. It's about the market digesting the news that Bitfarms just closed a massive $588 million convertible senior note offering. This isn't just a small capital raise, it's a war chest, and CEO Ben Gagnon has been explicit that this financial firepower is to move at full speed with their HPC and AI infrastructure development, specifically at their newly acquired sites in the United States, like the Panther Creek campus in Pennsylvania. This completely changes the equation. This isn't a stock for a set-it-and-forget-it Schwab Intelligent Portfolios account. This is a complex corporate transformation story. Let's look at the details of this recent trading action. The stock has been all over the map, dipping hard towards 370 just a few days ago before this massive rip back to 461. This isn't retail FOMO. This is the battlefield where smart money traders are weighing the two new realities. On one hand, you have the dilution. The company just issued $588 million in convertible notes due in 2031 at a 1.375% interest rate. The initial conversion price is set at approximately $6.86 per share. This means that if the stock price rises above that, a massive wave of new shares could be created, diluting existing shareholders. This is the kind of detail that traders on the Interactive Brokers platform are modeling out, while many retail investors just see the 11% green candle. To its credit, Bitfarms management was smart about this. They used some of the proceeds to purchase a capped call, which is a complex derivative strategy designed to offset the dilution for shareholders up to a stock price of $11.88. This is sophisticated financial engineering, not the simple buy-the-dip mentality that often surrounds online investing. It signals that management is trying to protect shareholders, but also that they are taking on a lot of new debt. This debt is the second part of the story. In addition to the convertible notes, they also just converted a $300 million debt facility with Macquarie into a project-specific financing to build out that Panther Creek AI data center. So Bitfarms is levering up. The expectation is that they are a Bitcoin miner. The reality is they are becoming a leveraged data center infrastructure play. Why are they doing this? Because they have to. The 2024 Bitcoin halving was brutal for miners' margins. We saw it in their own numbers. In the first quarter of 2025, Bitfarms' average direct cost to produce one Bitcoin was $47,800. That's up significantly from $40,800 in the prior quarter. Now, with Bitcoin at $108,000, that's a fantastic margin. But what happens if Bitcoin pulls back to $70,000 or $60,000? Their margins get squeezed to almost nothing. The halving cut their revenue per block in half, and their costs are rising. They cannot survive long-term as just a Bitcoin miner in this high-cost, high-competition environment. They must find another revenue stream. So this pivot to AI and HPC is a move of necessity, an attempt to build a second, potentially higher-margin business that isn't tied to the wild volatility of a single digital asset. They are trying to sell compute, the same thing that has driven NVIDIA stock into the stratosphere. This makes Bitfarms a much more complicated investment. It's not something you just throw into your Fidelity IRAs and ignore. This is an active, high-risk speculation. It also helps explain their hold strategy, or lack thereof. Bitfarms is not a Bitcoin vault. Their own reports show they are consistently selling the Bitcoin they mine. They sold hundreds of coins in Q1 and April to fund capital expenditures and operations. As of their last major update, they held around 1,166 BTC. They are using their Bitcoin treasury as a financing tool, liquidating it to fund this transformation into an AI company. This is a critical distinction for investors who think they are buying a proxy for a Bitcoin treasury. You are not. You are buying an operating company that is selling its commodity to fund a new venture. This is the absolute definition of self-investing. You must do the homework yourself, because the surface-level story is misleading. You won't get this kind of deep operational analysis from a simple Robinhood app interface or basic investing sites. Comment below with your thoughts on this. Do you think this pivot to AI is a brilliant strategic move by Bitfarms to secure their future? Or are they just chasing the latest hot trend and taking on too much debt? I'm genuinely curious to read what you think. Now, let's briefly touch on the underlying business for those who are new to it. Bitfarms historically has been a vertically integrated Bitcoin mining company. They build, own, and operate their data centers, primarily powered by cheap, often surplus energy. They have 15 operational sites across the United States, Canada, and Argentina. Their mining operation is still a beast, hitting 19.5 exahash per second back in March, with a fleet efficiency of 19 watts per terahash, which is very competitive. This core business is still the engine, but as we've established, that engine is now being tasked with funding the construction of a completely new parallel business in HPC. This is where the 400% rally in the stock starts to look shaky. Zacks Investment Research recently put a hold rating on the stock, warning investors that despite the incredible momentum, the company's fundamentals are not keeping pace. They are still unprofitable, reporting a net loss of $29 million in the second quarter. This is the core tension, a stock price that has gone parabolic versus underlying financials that are still in the red. This brings us to the future outlook, and the disconnect here is one of the widest I have ever seen. The bull case, the narrative that everyone on SoFi investing platforms is buying into, is that Bitfarms has timed this perfectly. Bitcoin is consolidating for its next massive leg up to $150,000 or higher. This will cause the mining business to print cash. Bitfarms will use that cash, plus the $588 million from the notes, to rapidly build out its AI data centers. By 2026, they will have two massive high-margin revenue streams, a top-tier Bitcoin mining operation and a high-demand HPC compute business. In this scenario, the stock blows past the $686 conversion price and the $1188 capped call, and everyone who bought at $461 is a genius. This is the expectation. Now for the reality, which is reflected in the institutional analyst targets. Fintel reports an average one-year price target for Bitfarms of just $2.55. The high-end target from any analyst is only $3.70.